Welcome back to Talk Tickers, the show for the experienced investor, where we strip the earnings calls down to the raw signals. I'm your host.
And I'm your expert guide.
Today, we are breaking down the fiscal year 2026 Q2 earnings for the consumer staples giant Procter & Gamble. And, usually a P&G call is, well, it's pretty steady.
It's steady, it's boring, it's dividend-focused stuff.
Exactly. But looking at the data today, the transcript, the analyst notes, the options flow, something weird is happening here.
Yeah, it's a really fascinating setup. So it's January 22, 2026. The print dropped pre-market. And the vibe is it's a classic staples grind quarter.
A staples grind.
You've got a messy top line, a very disciplined bottom line, and a management team basically asking investors to just trust the process for the next 6 months.
And trust the process is doing a lot of heavy lifting today. Because when you look at the headline numbers, this was not a blowout quarter, but, and this is the market isn't punishing them, the stock actually popped.
It did. And we're going to figure out why flat organic sales are somehow triggering this huge bullish option spike. Because on the surface, the math, it just doesn't quite add up.
It sounds impossible. It sounds like they found a way to grow value without actually selling more stuff.
For a company that sells toothpaste and diapers, yeah.
So let's get right into the headline numbers. What was the raw print?
Okay, so revenue came in at $22.21 billion.
Right.
That's a miss against the consensus of $22.36 billion.
Right.
So not a disaster, but they came up about $150 million short.
Okay, so they sold less than Wall Street wanted. What about the profit, the bottom line?
That's the other side of the coin. Core EPS earnings per share came in at $1.88, and that's a beat by 2 cents.
So they missed on sales but squeezed out more profit than expected.
Exactly. They were disciplined.
Which brings us to the growth profile, or I guess the lack of it. Organic sales were dead flat. Can you just quickly break down organic sales for everyone? Why is that the number we really care about?
Of course. It's really the cleanest measure of a company's health. It strips out all the noise from currency swings, from acquisitions. It tells you, is the core business actually growing?
And the answer this quarter was no.
0%.
Zero. That feels ominous.
Well, it's the composition of that zero that's so important. Organic sales are made of two things: price, how much you charge, and volume, how many things you sell.
Okay.
In this quarter, pricing was up 1%, but volume was down 1%.
So they charged a little bit more, but people bought a little bit less, and it all just washed out to zero.
Precisely. And usually when you see negative volume for a giant like P&G, especially when their pricing power is fading, only up 1% investors usually run for the hills.
But they didn't. That's the strange part. The stock was trading up about 2.2% in the pre-market, around $149.
And here's where it gets really weird. The options activity is just screaming. Market beat flagged over 241,000 call contracts traded. That is a 760% increase over their typical volume.
Wow, 760%. That's not just retail investors buying a few lots. That's institutional money talking.
Oh, absolutely. The market is placing a huge bet on a turnaround. They're looking right past these flat sales and buying into the story management was selling on the call.
So let's dive into that story, because when you look under the hood of the report, it really is a tale of two cities, geographically speaking.
It's stark. On one side, you have the problem child, which surprisingly is North America.
Down 2% organic, volume down 3%. That's a serious drag.
It is. Now, the CFO, Andre Schulten, he was very quick to blame this on, quote, base period dynamics.
Which sounds like corporate speak for, please ignore the bad numbers. Is there anything to that?
There is, actually. He's talking about the comparison to last year. If you remember, there were fears of port strikes, hurricanes, and retailers were doing what's called pantry loading.
Right, just stuffing their warehouses with inventory because they were scared the supply chain would break.
Exactly. So Schulten's argument is that sales looked artificially high last year, which makes this year look artificially low, especially for baby, feminine, and family care.
Okay, but even he admitted that wasn't the whole story, right? He said they still have work to do.
Right. He didn't let him off the hook. He said, even if you strip out that noise, the rest of the business was only up 1%.
Yeah.
He explicitly said they are losing market share in the U.S.
So the U.S. is the problem, but then you flip the page to international, and it's like a completely different company.
It really is. Latin America, plus 8% organic growth. Mexico and Brazil are just on fire.
Europe was up 3%. And then there's China. I feel like every other call we analyze, China is a disaster zone.
The macro there has been so tough. But P&G grew 3% in China. That is a really notable performance.
Okay, so U.S. shrinking, international growing. How does the CEO, Shailesh Jejurikar, plan to fix the volume problem here? Because the easy answer is just cut prices.
But that is not the P&G way. And they really don't want to start a price war. Their strategy is what Jejurikar keeps calling superiority.
Which, sounds like a corporate buzzword until you hear the examples they gave. They got really specific on this call.
They did. And this is the key to their whole intervention strategy. They aren't trying to be cheaper. They're trying to be so much better that it feels like an experience.
Let's talk about the Silk case study. This was for baby care in China.
Right. So to win back premium consumers there, they launched Pampers Prestige. And Jejurikar explained that Chinese parents are incredibly discerning. Softness is everything.
So what did they do? They put real silk ingredients in the diaper.
I know. They leveraged 2,000 years of cultural history where silk is the ultimate status symbol. It's shiny, it's soft, it's luxury. They're not just selling dryness. They're selling a status symbol for your baby.
In a diaper that you're going to throw away.
Psychologically, it's brilliant. And it worked. He said it drove double-digit growth in that segment. They gained nearly 3 points of market share.
That's unbelievable. And they had a similar story in Mexico with fabric softener, right?
Yeah, Downy Intense. Their data showed Mexican consumers want laundry that smells rich and fruity, almost like a fine perfume.
So they launched a high-intensity perfume version.
And boom, double-digit growth.
Yeah.
Again, they didn't cut the price. They increased the sensory value.
And the reason we're talking about silk diapers and Mexican perfume is because this is the exact playbook they are now bringing to the U.S.
Exactly. They said they're applying these interventions here. You're seeing it with Tide Boosted, which they're calling the biggest liquid upgrade in 20 years. Tide Evo, new Olay jars.
They are making a massive bet that the American consumer, who everyone says is pinched by inflation, is still going to pay up for a superior experience.
It's the lipstick effect for household chores. You can't afford a new car, but you can afford a small indulgence, like a better-smelling laundry load or a silkier diaper.
It's a bold bet, but this innovation isn't free. Let's talk about the P&L. How did the margin math work out?
This is where you see the grind. Gross margins were down. Core gross margin was down 50 basis points.
0.5%. Doesn't sound like a lot, but on $22 billion, that's real money.
It's significant. But what's fascinating is how they got there. They actually had massive productivity savings. I'm talking plus 160 basis points.
Okay, so they saved a ton of money. Where did it all go?
It got eaten. 60 basis points went back into reinvestment. That's the marketing for the silk diapers. And then the big one. Tariffs took another 60 basis points.
And they were really clear about that, weren't they? They put a hard number on it.
Yep. A roughly $400 million after-tax headwind from tariffs for the full fiscal year. That's a big, unavoidable hit.
So despite all that pressure, they held their full-year guidance.
They're holding the line. Organic sales, flat to plus 4%. Core EPS, still expecting $6.83 to $7.09.
But I did see a note that they cut the gap guidance a little bit.
They did, yeah. That's because of higher restructuring charges. They're in the middle of a big restructuring to free up capacity.
And this isn't just about layoffs, this is about technology.
Exactly. This connects to what the CEO called Supply Chain 3.0 and the data lake.
I loved this part of the call. He suddenly stopped sounding like a soap salesman and started sounding like a tech CEO.
And there seems to be real substance there. He talked about using AI for molecular discovery in R&D, like using algorithms to invent better cleaning agents faster than a human could.
And programmatic shelf tools.
Yeah, using data to automate what's on the shelf. Basically building an algorithmic brand machine.
Yeah.
He made this huge claim that they can grow from here on out without adding headcount.
Which is a massive statement.
It is. It means the pain of restructuring now is an investment in a leaner, more automated future.
So let's bring it all back to the investor. The stock is up, the guidance is holding, but it feels like everything hinges on this promise of a stronger second half.
That is the bet. Management used that phrase over and over. They need the U.S. to stabilize, they need these interventions to work immediately, and they need to outrun those tariff headwinds.
It's the ultimate show-me story. The market bought the narrative today, but the margin for error is basically zero.
If the U.S. consumer decides to trade down to private label instead of trading up to Tide Evo, that second half story just vanishes.
So what's the big macro signal here for investors listening?
I think the signal is that the era of just hiking prices for easy growth is over. Pricing was only 1%. They know they can't push that lever much more. They have to get volume back.
And they have to do it in an environment where consumers are, quote, choosy.
Exactly. So this is a huge test. If P&G succeeds, it tells us the premium consumer is resilient. If they fail, it tells us the consumer has finally tapped out.
Okay, so we've gone through the numbers, the strategy, the silk. Now let's get theoretical.
It's time for this segment where we throw caution to the wind.
This is not financial advice. Please do not do this. We are just two voices on a podcast. But if you were pitching a high-risk, high-reward idea based on this call, what's the trade?
I'm calling this one the Silk Road spread.
The Silk Road spread. I like it. Break it down for me.
All right, so we know the smart money is betting on the breakout, that 760% call volume spike. So leg one of the trade is you go long third, the July 2026 out-of-the-money calls.
Okay, so you're betting the second half recovery actually happens. You're betting the interventions work and the U.S. numbers bounce back hard.
Exactly. You're writing that narrative, but you have to hedge it, right? What if the consumer is actually broke and this whole thing is a fantasy?
Right. If they're broke, P&G gets crushed. So what's the hedge?
You sell near-term puts on generic private label manufacturers. Or you could short a basket of value tier retailer ETFs. The companies that make the store brands.
Wait, hold on. Walk me through the logic there. Why would you short the cheap stuff if the economy is bad? Normally, people trade down to generics in a recession.
That's the standard logic. But we're not betting on standard logic. We are betting on the lipstick effect, triumphing over basic economics. You are making a bet that American parents are going to demand silk diapers.
You're betting on the absolute resilience of premiumization.
You got it. If the U.S. consumer really acts like the Chinese consumer, those P&G calls will print money. And at the same time, if people are trading up to Superior Tide and Pampers, they're trading away from the generic brands. So your short on private label also pays off.
So it's a bet against the trade down. It's a bet that status and experience matter more than saving a few bucks.
It's outrageous because all the economic textbooks say it shouldn't work. But P&G just showed us that in a tough economy in China, people paid more for a diaper because it had silk in it. If that psychology holds here, this is the winning trade.
It's completely counterintuitive. I love it.
It's a bet on human nature over wallet logic.
All right, let's wrap this up. Give us the main points for the road.
Revenue miss, EPS beat, organic sales are flat, and the devil is in the details. The U.S. is a drag because of some inventory noise, while international is the engine.
And management is confident. They have the tech, they have the supply chain 3.0, and they have the silk diapers.
But with that $400 million tariff hit coming and volume still negative, that second half miracle needs to show up in the data, and it needs to show up now.
The market gave them a hall pass today, but the next print has to deliver the volume, or that patience is going to run out real fast.
Absolutely. The clock is officially ticking.
That's it for this deep dive. Check your risk tolerance, do your own homework, and remember, sometimes the biggest signals are hitting in the most unexpected places. This was Talk Tickers. See you at the next print.